Good morning and welcome to Morning Markets. Today we're going to focus on the main event of this week for markets, which is the US inflation report. So we'll look at the details and look at how the market reacted. So the main event of this week for markets was the latest US inflation report for March. I think for context, coming into this year, or what we've seen this year, is that US inflation has been stronger than expected repeatedly and actually inconsistent with getting inflation towards the Federal Reserve, the US central bank's target of 2% inflation. In addition to this, we've actually seen economic growth remain remarkably resilient, as have US labour markets. And as such, we've seen interest rate expectations change quite a lot in the markets this year. For context, at the start of the year, the market was expecting interest rates to fall by 1.5%. That's been pared back to just 0.6% before the release of the US inflation report. So yesterday we got the report. The details were slightly disappointing. It came in stronger than expected. So when we look at headline inflation, that increased from 3.2% to 3.5%, and that's on a year-on-year basis, and the month-on-month figure was up 0.4%. And we often look at inflation by stripping out volatile components such as energy and food. And so looking at core inflation, again, that was stronger than expected, coming in at 0.4% for the month of March versus 0.3% expected. And this is the third month in a row that core inflation came in at 0.4%. So when we annualize the last 3 months, the rate is at 4.5% year on year, which is a concern for the Federal Reserve. It's important to look at the underlying drivers of inflation, and it's almost exclusively due to services inflation, which is often a lot stickier and often correlated with wage growth, which often is a concern for the Federal Reserve. If we look at the different components within the services inflation basket, it's down to 3 things really that was noticeable in March. Shelter costs continue to remain elevated and inconsistent with more timely indicators, and also motor vehicle insurance and medical costs were also noticeable increases during the month, which is influencing that services inflation basket. It really highlights that consumer demand remains very strong, and that's forcing prices higher in services. And that is a challenge for the Federal Reserve in terms of getting to their 2% inflation target. So the reaction from the markets in terms of interest rate expectations, we saw quite a big change in terms of when they expect the first interest rate cut. That changed from June, pushed out to November now, and the number of interest rate cuts actually fell as well. In terms of the broader market response, in terms of the bond market, we saw the US Treasury 2-year yield increase by the most in 18 months. So that was up 0.2%. But the fallout in the US government bond market rippled across global government bonds. So we saw negative returns in UK gilts. And then if we look at equities, we saw negative returns most noticeably in US equities, with the smaller, more interest rate sensitive companies underperforming the most. We saw a bit of strength in the dollar versus the pound, and that was actually supportive for the FTSE 100. That managed to eke out a positive gain of 0.3%. That's everything from us today. Thank you for watching, and we'll see you tomorrow.